So this is a video about evaluating the impact of COVID-19 on bonds. Um, the bond as a security is different compared to stocks. With a stock, you have the expectation of future earnings changing, especially in light of the events such as COVID-19. It changed economic growth. It changed how businesses perform their operations, and therefore our expectations of their future income have changed dramatically. And therefore, stocks have an added component of our expectations as to how they will continue operating. With a bond, it's actually a simpler instrument in which you lend money to the borrower and there's a promise of an interest payment. You could receive a coupon, or you could simply pay less today and then receive a higher amount later. Now, the bond actually has a default risk, which means that the borrower may not pay us back at all. Therefore, the way that coronavirus epidemic affected bond prices has to do more with the increased risk than the operations of companies. So similar to our evaluation of stocks, I am going to look at ETFs, portfolios of assets, specific to bonds. I have created a small list of 10 ETFs, 5 of which are US Treasury-based ETFs, whose assets are mainly US Treasuries, if not all. And then another 5 for corporate bonds. Obviously, the bond domain is significantly more diversified than just treasuries and corporates. There are municipalities, there are international, and so on and so forth. But for this lecture, we're going to be talking about these two mainly to evaluate the impact of COVID-19 on bonds. So I logged into tradingview.com, and again, you can use any website that would actually give you historic prices on a chart. I just happen to like this one. I pulled up an ETF with the symbol of SHY. It's managed by a company called iShares. It includes US Treasury bonds within its portfolio with maturities of 1 to 3 years. So with a bond, you have a maturity, which means you lend the money today, and in about 1 year, 2 years, 3 years, you get your money back. So usually, if it actually expires or matures within that year, we refer to them as bills. So you have US Treasury bills, but then these mature 1 to 3 years, which means that this ETF portfolio per se will include US Treasuries, individual bonds that have maturities between 1 to 3 years. So these are short term. So when you buy a short term bond, you simply are lending money and receiving your money back and hoping that you're going to lend today, say $990, and then you're going to receive back $1,000. So you're hoping to make about a $10 on this specific bond. The risk about the bond or with the bond is that you may not get your money back, but you're hoping that US government, that's what the US Treasury bonds are borrowed by, US government will honor their commitment and they will pay it back to you. And therefore, we consider the US Treasuries safe or safer compared to other types of bonds by corporations or municipalities or other government bonds. And the shorter the period, you're more likely that you're going to get your money back. And also, there's always an opportunity cost. So for instance, right now, if you were to lend your money for a 30-year bond, you're basically giving up your money today, lending it today, with today's conditions, where the interest rates are super low, and you will get your money back in 30 years' time. So right now, the interest rates may be really, really low, but you don't know what they're going to be in 5 years from now, 10 years from now, let alone 20 or 30 years from now. So the longer you lend your money, more likely that you will regret it. More likely that you will regret lending at the, back then, whatever the interest rates were. So for instance, right now, interest rates are really low. So likelihood is you will regret it. There's also a possibility that you may be very happy with it because interest rates may even go lower. In some countries, we have negative interest rates. So it's just the likelihood of opportunity cost, likelihood of regret increases with the length of the maturity. If you're going to lend your money for 3 months compared to a year, compared to 5 years, compared to 30 years, you can see how, even while I'm talking about it, you probably would feel a little bit more comfortable lending your money for 3 months, less so for a year, a lot less so for 5 years, and a whole lot less so for 30 years. So the longer the period of time, longer the maturity, longer the period of time that you're lending the money, more likely is it that you might actually end up regretting your decision to lend your money to begin with. So now we're looking at the 1 to 3 year treasury bonds, and you can see that the price of this portfolio, this ETF, has actually gone down. Because, I mean, with a bond, like I said, it's a very simple transaction. You give your money and you want it back, plus the interest. With a stock, on the other hand, you are participating in the operations of a company, and you have a likelihood of earning a whole lot of money, but you also have a likelihood of losing money. And the price of your share may change. Now, with a bond, you give your money and get your money back. Now, in any given day, any investor have a choice to make. You can keep your money as cash. Like I said, coronavirus times, a lot of people refer to cash is king. And while you don't earn anything, you also don't lose anything. You could also invest it as bond. You know what you're going to get, and hopefully you will get it. Therefore, you have a limited risk. However, within the domain of bonds, obviously, you could take significant amount of risk or smaller risk depending on who you're lending it to or how long. But then when you invest it in a stock, then you're taking a whole lot more risk because now you are taking the operational risk and the price risk and the opportunity risk. And obviously how long you're going to keep it will become more of a risk as well. So when coronavirus epidemic started, people started to escape from higher risk instruments such as stocks and went to savings as cash and savings accounts and checking accounts, if you will, and also started to consider bonds. And as you can see, on a 1 to 3 year treasury bond ETF, that pays you about 1.5% annual yield. The price of this went from about 85 all the way to 86.63. And notice, I'm saying it went from 85 to 86 and 60. So it barely moved. You know, the scale is, see, 84.60, 86.60. The scale is $2. In fact, let's just show and compare this to S&P 500 ETF. Now notice on the left-hand side, you have the S&P 500, and on the right-hand side, you have the scale for the SHY, the bond. So the blue line is your S&P 500, and then the colored um, candle chart, you have or the green and red candle charts, you have the SHY. So the colorful bond is actually not that colorful because the price only went up about $2. On the other hand, on the S&P 500, you really have a roller coaster effect, and it went from almost $340 down to $220 or so. So that's about a 50% off a drop. Now, these two lines on the chart are based on prices. Again, on the left-hand side, you have the S&P 500. On the right-hand side, you have the SHY, but compared based on prices. And I just wanted to show you how much the stocks dropped versus the bonds, and notice the difference in scale. But to make this a little bit more emphasized, I want to show you another chart of these two compared, and this time it's based on returns, on actual percentage return. Now notice the same red and green candle chart is the SHY, and then the blue is the S&P 500. Now again, notice that I'm going to do a year to date, and notice that the S&P 500 drop is still there, but this time it's not about prices. This is about the return. Like if you were to buy SHY, the bonds, January 1st, where would you be right now? You would be at about 2.36% profit. And if you were to buy the S&P 500 index ETF at January 1st, where would you be right now? You would be about 0.5% profit. So this is based on how much of a profit or loss you would have realized if you invested in either of these investments as of January the 1st. Now, the blue line is the stocks, and then the red and green colorful lines are the bonds. That's the candle chart. Now, notice how and let me just make this video just a bit smaller for the time being. Notice how we have on S&P 500, we have gone down to 30% loss on middle of March. And then we recovered, yes. But we have seen this much, and I bet that gave a lot of people a heartburn. Now, compare that to the bonds, where you don't have that much of a change. In fact, if anything, it went up. And at any point in time, when the market was going down and the losses were piling for stocks, this specific ETF, the bond, did not go down almost at all. So bonds provided a rather safe haven. However, this is not the case for every bond. So I created this list, and just as a comparison, we have different ETFs, BIL, SHV, SPTI, and so on and so forth. These are what we would consider to be the shortest period of time, and therefore, compared to the others, the more safer. And you have seen this one having an average price of 91.47 and a lowest price since January the 1st of 91.18 and highest price of 91.59. So you're talking about a 41 cents of a price change for this specific ETF, which has a risk of 0.31%. And then you have a short term, so about a year and maybe 1 to 3 years. And this has a range of about 1%, well, about 0.5%, and a range of about 91 cents. Then you have 3 to 5 years, the intermediate term treasury bond. You have seen as low as $30.84 and as high as $33.35, average price of $32.52, and your range is about $2.50. So the risk from your average to the lowest you have seen is about 5.16%. So notice how, as we increase the maturity, your risk is increasing. So for a longer period of US Treasuries, like 10 to 20 years, then you have a range of $28 with an average price of $161, which gives you a risk of 11%. Now, if you remember from other video about the stocks, you're talking about an average of about 20-25% risk from average to the lowest. Now you're talking about 11% to be a relatively high risk within the domain of bonds. Now, with respect to longer term, 20, 25, 30 years, then you have about a 14% risk from the average price of 41 to the lowest of 38.91. Now, these were all US Treasuries because we consider US Treasuries to be safer borrower compared to any other borrower, and also they are, they're everybody's favorite. Now, if you go to the corporate bond domain, then you have a relatively higher rate of risk. Now, with a long-term corporate bond, you have an average price of 102.25 that has actually gone down to 77.76, which gives you a risk of about 24%, which is within the same realm of risk we talked about with respect to the stocks. Now, we have two special ETFs, and I personally kind of like watching them because this J and K is actually short for junk. These are considered junk bonds. And their yields are considerably high, especially if you're thinking about investing in stocks. But notice the name, junk. So let's take a look, J and K. Notice this is a portfolio that actually pays about 5.77% yield, meaning that you actually get a monthly dividend. On an annual basis, you get about 5.77% return. Now, compare that to your checking account, which you get nothing. This is incredibly high. So notice that this is for bonds. However, they are junk bonds. Let's take a look at the holdings. You have these companies that pay significant returns, which classify them into a junk bond category. And these combined into two separate portfolios managed by two different companies, you now have a risk of about 17% this year. That is from the average price to their lowest that we have seen. So again, compared to the stocks, bonds fared relatively well, relatively better, and their drop wasn't all that bad. They had a good recovery compared to stocks. And for shorter term treasuries, a lot of investors considered them to be safe havens. So not only they didn't go down mostly, but they actually went up. And this pretty much concludes our discussion about this impact of coronavirus or COVID-19 epidemic on the bond market. And if you have any questions, please do let me know. And thank you for watching.